All right, let's talk about real estate. Today, we're going to lay out a real blueprint for property investment. We're talking about going way beyond just buying a house and actually creating a powerful financial portfolio. To do that, we're tapping into the expertise of professional consultant Basit Yousuf from ARBE Global to really demystify this whole process.
So many of us have this dream about property investment. It seems simple, right? You just buy a place, hold on to it for a while, and then sell it for a big profit. But the thing is, the reality, as anyone who's actually done it will tell you, is a whole lot more involved. It's a dance of strategy, timing, and, probably most importantly, discipline. And that's exactly the gap we're going to close today.
So here's our game plan. We're going to start by really nailing down what property investment is versus what we think it is. Then we'll get into reading the market signals. After that, we'll map out a smart way to get your foot in the door, then talk about playing the long game. And finally, we'll see how getting some professional help can give you a massive advantage.
Okay, so first things first. What are we really trying to do when we invest in property? Because it's about so much more than just owning some bricks and mortar. It's about making that building go to work for you. When you break it down, property investment is buying a tangible asset, something you can actually see and touch, unlike a stock. And the whole point is to make money from it in a few different ways. You've got capital appreciation, that's when the property's value goes up over time. You've got rental income, which gives you that steady cash flow. Or you can use it to diversify your investments, spreading your risk. The key thing to remember is this. Property is a slow-moving game that absolutely rewards patience.
Now, here's a massive mistake a lot of people make. They think the property market just goes up in a straight line forever. It really doesn't. It moves in these predictable cycles, and learning how to read those cycles is what separates the beginners from the pros.
And this cycle, well, it pretty much maps out the emotional roller coaster of the market. It all starts with the recovery phase. This is where the really smart investors get in quietly. Then comes the growth phase, which is when everybody else starts to catch on. The peak? That's when emotions take over and people buy based on pure hype. And then, inevitably, comes the correction, where folks who bought at the top often end up panicking. Just understanding this cycle is your best defense against making a purely emotional decision. So, what makes these cycles happen? Well, it's not random. It's a combination of these key drivers right here. I want you to think of this list as a professional's dashboard. They're not just looking at house prices. No, they're digging into economic growth, what interest rates are doing, population shifts, new train lines being built, all of it, to figure out where the market is actually going next.
And that really just highlights the huge difference in approach. The amateur investor sees a headline about prices going up and they get FOMO, they jump in. The professional sees that same headline, nods, and then goes deeper. They're looking at the underlying data, jobs, supply, government policy to make a calculated move. One is just reacting, the other is being strategic.
All right, so now that we know how to read the market a little better, let's talk about actually getting in. A smart entry into property isn't about getting lucky or trying to perfectly time the absolute bottom of the market. It's about having a deliberate, disciplined plan. It really just boils down to these 3 steps. First, you have to know why you're doing this. Is it for long-term growth, quick rental income, both? Next, you've got to be totally honest about your finances. And please, never invest every penny you have. You must keep an emergency buffer. And then, once you know your goals and your budget, you can finally pick the right kind of asset for you. And that leads us right here. Look, there's no such thing as the best investment overall. It all comes down to your goals. Residential properties, they're stable, lower risk, but the returns or yields are usually lower too. Commercial property can get you higher yields, but it's a bigger commitment and a bit riskier. And then there's land, which has incredible potential to appreciate in value, but it gives you zero cash flow and it can be really hard to sell quickly. It's illiquid. Your choice here has to connect directly back to the goals you set in step 1. Okay, so you've done it. You bought your first property. Guess what? The work isn't over. In a lot of ways, it's just getting started. Now we get into the long game. And this is all about doing your homework, your due diligence, and mastering the superpower of patience.
Think of this as your non-negotiable checklist. A cheap property in a terrible location isn't a bargain, it's a trap. The numbers have to make sense after you factor in all the costs, maintenance, taxes, everything. And of course, the legal side has to be absolutely solid. If you skip any of these, you can turn a great-looking asset into a huge headache.
I want to just pause on this for a second because this is so important. Most successful property investors win because they wait, not because they trade frequently. Real wealth in property is built over years,
sometimes decades, not months. It comes from that slow, steady compounding of value and the cash flow from rent. Shifting your mindset from active trader to patient holder is one of the most fundamental things you can do.
But hey, holding for the long term is impossible for everyone, right? Life happens. So what if you know you might need the money in a few years? That's fine, as long as you plan for it from the start. Your whole strategy just changes. You'll want to focus on properties that are already built and have tenants. You avoid speculative stuff, keep extra cash on hand, and this is absolutely critical. You figure out your exit strategy before you even buy. And the number one rule? You never, ever panic sell. That is the fastest way to destroy wealth in real estate.
And all of this leads us to our final section. Look, navigating all these things, the market cycles, the due diligence, the strategy, it can be a lot. And that's exactly where getting professional guidance stops being an expense and becomes one of the best investments you can make. A great consultant is basically your filter and your shield. They connect you with deals that actually make sense for you. They use hard data to cut through all the market noise and hype, and they do that tough, detailed homework that protects you from all those common and very expensive rookie mistakes. And then, as you start to grow, a portfolio manager becomes so important. This is really the next level up. They help you stop just collecting random properties and start building a balanced, strategic portfolio. They're the ones who help you decide when to sell one asset to buy another, turning what you own into a structured, wealth-creating machine. So when you boil it all down, it comes back to this one thing: mindset. Amateurs get pushed around by fear, greed, and what everyone else is doing. Professionals, they operate on a whole different level, guided by data, strategy, discipline, and patience. That's it. That's the fundamental difference between success and failure. And that really leaves us with one final thought to chew on. The next time you think about getting into the market, just ask yourself this one question: are you just buying a property, or are you building a portfolio? Because your answer to that will change everything about your approach and, ultimately, your success. Thanks for joining us.